Hello everyone, welcome to Smart Investing. I'm Albert, host of the channel, and today this video is going to be about the banking services sector. I know that I should have been uploading a video a few days ago, but I've been busy, and then obviously I'm not getting as much views or likes or subs as I want to lately, so I'm kind of going to slow it down anyway. Uh, Again, the markets have been going up the past few weeks, but we're already close to half of the year, and for the most part, stocks have been going down. But for some reason, the last few weeks they've been going up. I don't know why. There's no really good reason or no good news, to be honest, as to why stocks have been going up. The only thing I can really think of is that people that have been selling lately, they have to buy back their position. So when you obviously sell first, you have to buy later on. So pretty much it's like using a credit card. You're paying for something now, even though you don't have the money. So basically later on, you have to pay that money. And if you don't, you're going to be paying fees on top of what you owe. On top of that, I don't know what kind of fees they do when it comes to the broker account when you're doing those credit spreads. I have no clue. Again, depending on the platform, all those fees vary. So I have no clue as to what those fees consist of. So look them up, ask online or something, ask your platform, find out something. Go to customer support or something. But yeah, and invest in that time that is needed when you're gonna do those credit spreads because it's not fun. It's real ugly when you have to borrow money and then buy back your stocks later on. So, anyways, that's what I think that what's going on in the market, and I just see dead cat bounces, anyway, because back to back days, stocks markets has been going up, and like over 90% of the stocks have been going up. So it just makes no sense. This is a classic bear rally. It's just a fake rally, pretty much. So I still think stocks are still gonna go down slightly towards the end of the year anyway, with everything that's going on. So the economy looks like crap, to be honest. I don't know what you guys think, but yeah, it looks like crap. So moving on, let's start with the next five stocks that I have for the banking sector. So the first one up that I'm going to start out with is Fibk. So again, I'm using Webull. Webull has just updated their app. Again, I've said it before. They updated their app maybe like 2 weeks ago. So I've been out of the loop. Excuse me. I've been out of the loop as to what's been going on, but apparently uh, they made some slight changes for the app. So we're just gonna deep dive right into that and see what's been going on. So we have here on the chart, it looks like a downtrending chart, as you can see. So let's look at the first page. They are called First Interstate Bank System. Market cap is respectable for a bank. Not too big and not too small. They're small enough company, but not too small. Earnings and dividends. It looks like they can cover their dividends based on the earnings. They look overvalued based on the info that I see in front of me for the first page. I know people like this with the 4.31 dividend yield. Again, that's not something of my interest. I'm sure other people have that kind of interest where they prefer the yield versus the total amount. So for the 5 year, you're pretty much broke even. we have here for the analysis and the quant ratings. Again, this is not accurate. I still think it's sort of a guideline, but it's not as accurate as you may think. Again, everybody has their own sources and information and their own strategies when it comes to deciding certain factors as to what stocks you like and what stocks you don't like and why you choose them and why you don't. Again, also with price points as well. But again, I'm not licensed or insured, so I'm not allowed to talk about that. So again, this video is just for educational purposes. So we're going to be reviewing a little bit for the technical analysis. This is something I have to get used to. I think excuse me. I think that when it comes to looking at the quant rating, again, it's not much of a deciding factor for me because I've been doing these kinds of projections and ratings for the longest, if you see my channel. So we have here a dip in Q1 2022, and it looks like they are aiming for about that line. That line, they are estimating, I'd say, about 47 cents. So that's definitely on the positive side. Again, I don't care for this stock. It hasn't done much. Only a $16 difference. It broke the $10 dollar spread, but I just don't like companies that are that cheap when it comes to certain sectors. So let's look at the ROE. Let's look at it annually. I think my internet is a little slow. I don't know why it's not. Yeah, it must be a little slow. It's not loading as fast as I want it to. And again, you can see here I'm having some sort of complications. Yeah, I'm having some internet complications. So anyways, I'll just go with what I have. So we have here 89% debt, and the debt has been going up. Again, if you see my channel, if you've seen my deciding factors, I do not like debt. So obviously, it's typical for banks to do those high percentage loans like that because they depend on consumers to pay them back. So anyhow, we're gonna look at some cash flow, and it looks like they would break even for their cash flow. And let's see something. So we have peer comparisons. They don't really rank high in anything. All I see is the net margins that they are. Right here, it ranks them number 9. I hope that's up to date because, again, honestly, I'm not sure. This whole peer comparison, they had this in the first update, the very first update. So, again, as long as it's up to date, that can be a very useful tool to use as an indicator as to what's going on in the market against their peers, so that way you can rank them. So let's look at dividends real quick. The last raise was in 2020, as you can see here. As you can see here in 2020. So they had a dividend cut in 2020 from 60 cents and it went down to 34 cents. That's almost half the value. So from 2020, as I circled, they did start to grow the dividend payment, and then in 2021 they increased it But then in 2022, right here, it looks like it remained the same at 41 cents. So that is definitely not a good sign. And again, you can always find better companies with better evaluations, looking at it from a fundamental view, technical view, and also by using a quant rating. Just excuse me, I'm trying to sit up and get comfortable. So okay, that's done, and the next one up that I have. So FIBK, I'm gonna say no. I don't like it. And also I don't like it for watch list. So next one up I have is SBT Sterling Bancorp. We can see the 5-year going flat, slightly going up since 2020, but that's typical. But yeah, that's not much of a difference, because from here to here that's only let's see. So let's see from down here it's about $3, and all the way up here that's only like 6 and change. So that's not even a $5 difference. That's like 4. Again, 52-week high and 52-week low of the difference of that is about $3. So that is definitely not attractive for any kind of investment. And it's cool because you actually get the numbers before you even invest in it. Again, that's why you just have to do your homework like I do. Or if not, stick to the channel and I'll teach you and let you guys know. I know people don't like putting in some of the work that I do, but this is what the channel is for. So anyhow, off the bat, I'm going to say no, just because of the 52-week high and low. I already know for every piece of information that I get, I have to see it fundamentally, technically, and from a quant rating. And then I pretty much uh, narrow everything down and actually see if it's a good stock or not. The feeds, I gotta stay away from that. That is a new tab, so I don't find it as useful as other tabs. So I kind of stick with what I like and what I know. Again, I'm not worried, or I'm not concerned about learning new and other factors into decisions. It's just that uh, I haven't seen a better process as to people coming up with a better solution. But until then, I'm sure we will finally get it one day. But as for the feeds, I'm not fond of it. I just don't like it as much as I think I would. So, you know, there can always be room for improvement. So again, right off the bat, SBT, I just don't like it from a fundamental and technical standpoint. Again, all these analysts I don't even look at analyst ratings or anything. They're always gonna recommend to buy. It's rare that they tell you to sell. So again, you have to do your own homework. So from the quant rating on Webull, it's showing that momentum is at an 8.00. So when I see that, and what that is telling me is that it might be a stock that has potential to be a short-term play. And then also on top of that, it started to gain traction. It's starting to gain, as they say, momentum. But pretty much all they're saying that it's starting to gain popularity. It's starting to engage activity for this stock. So I mean, I wouldn't watch this. I wouldn't care about it too much. I just look for top-notch companies and see if they're willing to do better in the future, or actually forecast a company doing still pretty good during bad times. So SBT does not pay a dividend. It's rare that a bank doesn't. So again, earnings per share is 0.52. That's positive, showing that it's undervalued. Um, Fair liquidity. And let's see, the last dividend was in 2020. And all they did was pay a penny since the start of 2018. So I'm going to say no. Definitely going to say no to this stock. And as you can see here, on return on assets, this company is run by clowns. I'll that's the worst thing you can see when companies are failing and they can't even break even. Is that when you have 2 solid years prior, then all of a sudden you want to cry wolf and say, oh, everything's too high and stuff like that. They should have thought that about that 2 years prior, when companies had the advantage and all those government handouts to pretty much bail them out. That's something. It's sad because people aren't talking about that, and I know there was pretty much money under the table because if there's market manipulation in the stock market, that means a lot of people uh, are manipulative, greedy, and uh, just selfish. Very, very selfish. So that's what the game is here. So for the debt, it looks like they lowered their debt by about 3%. Cash flow needs 970, 352, 970 million. So these guys have negative cash flow. I don't blame them. Even if they do cut the dividend, just the bank itself and the company itself is not worth it. So next one up, AVAL. I've seen this company before, and they were actually okay as a monthly dividend paying company. But as you can see here, ever since the start of March of this year, are they paying a dividend? Are they still paying a dividend? Well, we'll see. We'll find out. So let's look at the first page. So pretty much the earnings are covering the dividend, and that's all it looks like. They're just covering their earnings just to pay dividends. There's no future growth. There's pretty much no capital appreciation. The market cap is at 1.51. I mean, they're a small cap company, but they aren't. I don't think they're small enough to fail, if that makes any sense to what I just said. But it doesn't look like it. It doesn't look like a company. This kind of company would be. What is the market cap for it? So billion. So this is wrong then. I don't know why. I just saw the market cap, but then it's weird because I'm seeing companies in the trillions. Like, this is nuts. This is all inaccurate. So I don't know what to believe. Um, yeah, and other numbers saying that they're in the trillions. Yeah, this is way off. So again, decent company that does monthly payouts, but again, 52-week high and low. Just off of that, you're only gonna get like a $3 difference at most, for now. And again, I don't see it breaking to higher highs, according to the stock market and so many other peers in this sector. So I'm gonna say no to AVAL. I mean, I did actually say yes last year. I liked it as a watch list, but this year I just don't see it. So I'm gonna say no. Next one up is PNBK, Patriot National, I believe. So we're gonna look at the 5-year. It looks like it's holding up. I would like to see more action. So what was the 52-week high and low? Okay, that's not bad. They do not pay a dividend, which is kind of strange, but it's pretty smart, to be honest, because they save money that way. I mean, sure as hell, might as well save the company instead of letting it rot. Because that rotten smell might follow you to another company if you're pretty much doing average work. So, another stock with momentum. So, to me, that's telling me they're gaining popularity. Or again, it can be the same sector. So, we have here no dividends. I guess she knows how to take care of herself. So, we have 1 cent paying out every quarter. I do not like it. Last split was 1 for 10 in 2015. So automatically, I'm going to say no to that stock. I'm going to say no. So the last one up that I have is, did I do CM? So anyways, nice earnings. They can cover the dividend. They're underperforming and their PE is underrated. So 52-week high and low from 52 high is $66. 52-week low is at $50. They broke the $10 trend, which I usually choose a lot. And they have a difference of $16. So we're really gonna look into that. So we have Momentus. So we have it here as a momentum type of stock. We're gonna look at. So the volume is pretty high for this stock, just like they said. So volume is at 1.16. Average volume is about 870. So if that happens, then this stock can have potential then. So financials, you see all these hit and misses. It's gone down, now it's going up again. ROE. I don't like when they don't show no margins, net margins. Kinda throws me off. I could always look it up on Google and see what is the process for doing that, but for now I'm not liking it. So we have income, revenue. I don't know why it's not showing me the revenue. So 791 billion, 837.68 billion. So slightly higher debt, slightly growing in. So cash flow, we're gonna look at that. Damn, negative cash flow, that is horrendous. I thought they would have broke even with that, but it looks like they are not. Looks like they are not. So there you have it, guys. That's all I have for you. Stay tuned for the next video with the special dividend paying companies, and I'll be sure to add that soon, hopefully tomorrow. But anyways, thank you guys for watching. Take care, and I will see you guys in the next one.